And our next guest argues the risk reward is much better now than even before the trade war started. Fundstrat's Tom Lee is a CNBC contributor and joins us now from Miami. It's good to see you as always. How's that possible? How's the risk reward better now than then?
Scott, I think when we go back to February when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. You know, the tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, and actually a Fed that's on hold now, but probably doing more cuts now in 2026. And then from a company perspective, companies survived, I think, a black swan event. You know, that waterfall decline in equities and the sort of the near heart attack of the economy still was an environment where companies produced earnings that beat expectations. I mean, so this is the fifth stress test for businesses. I mean, when I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks.
So, I mean, because you keep talking about 26, you're not writing off the rest of this year. We still have 7 months to go.
Yeah, we have a lot of history to make between now and year end. But keep in mind that waterfall decline in stocks also was almost a complete reset in positioning and sentiment. You know, investors were forced to liquidate when the VIX hit 60. We know a lot of institutions didn't add risk back as the market rallied. So I think the pullbacks are going to be pretty shallow because investors just are underinvested at the moment. And then when you look at sentiment, it's barely turning neutral now. So if investors have been fighting this rally, as they become more neutral or more optimistic, that's upside for stocks.
I mean, Professor Jeremy Siegel, like you, has grown more bullish, pointing out, in his words, the Trump pivot on the tariffs, but he still acknowledges the fact that the tariffs are likely to remain in place. Whether it's 30 on China and 10 on everybody else, that's still somewhat regressive, is it not?
Yeah, well, I mean, you know, we are now in a new world of tariffs, and businesses are adjusting. I think one of the things that we're seeing is that the market is now in a position where they can start to look through some of the messy adjustments, right? We know there's been a disruption to the supply chain. I think stocks can look through that. But you're right, Scott, there is now this world where there's essentially a consumption tax in place on things that we're importing. But that doesn't mean we have to actually have the PE decline or the markets to fall. It's now just something we have to kind of manage through.
What about yields rising? How much of an issue potentially is that?
Well, I think Fed Chair Powell made a good point that long-term yields could be rising because of inflation volatility rather than inflation expectations going up. That's actually an opportunity for markets because if inflation volatility delivered is less than expected, then we could expect yields to come down in the future.
Yeah, but what about, I feel like the bulls are finding convenient excuses for why the rates on the longer end are going up. What if it simply, Tom, is the fact, and I don't mean to single you out, I mean, the professor in his answer to the question, too, put more credence in the fact that, well, maybe it's because growth is going to be better, not so much the deficit. However, what if finally the bond market is saying enough is enough and it's time to get real? And if you all don't, we will.
Yes, Scott, there was a moment like that a few years ago when, you know, when an auction went badly and many people declared this was sort of the end of the ability for the U.S. government to finance, and people panicked and the VIX surged. But even in that moment, it proved to be a buying opportunity for equities. So I think if there is a moment where maybe the bond market sort of has a tantrum about that, and I'm not saying it's going to happen, but if it does, I think we have to remember the U.S. is a huge economy. There is still a lot of trust in the U.S., and I think those who've called for the end of U.S. exceptionalism, I mean, I think that's been the premature call. And if none of those is true, the bond market and investors can handle even a 4.5%, 4.7% 10-year.